Okay, good evening, everyone. Carter, are we good?
Yeah, we're good.
Okay, welcome to our fourth Michigan Investor Group meeting, or MIG as we call it. Really grateful to see a full set of chairs here. It's great, really exciting. Tonight, well, I'm David Shirkey. I think most everybody here knows me. A couple of new guests, but tonight we have a unique topic. We're going to be talking about investing in life settlements. And we're fortunate to have a couple excellent presenters who are going to be sharing with us. But first, I want to cover a couple things. Our agenda will be, I'm going to talk for a couple seconds about our next few meetings that we have planned for the summer. And then Leo and Gerard will come up and talk about different aspects of this asset class. And then I have a very, very short presentation. And the Q&A can happen at any time. So please, as Leo or Gerard are talking and speaking, please raise your hand and ask questions as they come up. We should be wrapped up by 7:30. And of course, if you need to leave, please feel free to. And if we have discussion going on longer, we'll stay. So our next meeting is going to be April 24th. And the title is Anatomy of a Real Estate Deal. And basically, we have one of our MIG members who happens to own a lot of office and multifamily and some other things in mid-Michigan arena is going to take us through like 4 case studies of buying different properties that he's actually bought. And then give us some education on the real estate, calculations and real estate investing methodology and that kind of thing. Ryan, yep. You know him, right? Then we're going to have a self-storage investing topic in June. And then I'm working on later in the summer high cash value life insurance as a topic. So that might, and then finally, turnkey single family house investing. So those are our next 4 kind of planned. So back to tonight. Back in the summer of 2017, I was researching alternative investments, kind of starting this whole search out, and was reading some books and listening to podcasts, and just kind of new to all this stuff. And I heard a podcast talking about life settlements, and I had never heard that phrase and didn't know what it meant. And I just kind of thought, what in the world is this? And our guests are going to go in much more detail on this, but basically it's buying someone else's life insurance policy, and then you collect the death benefit when they pass away. Now they use different terms for these things, but that's basically what it is. So it's very different, very unique. So then I kind of got convinced. I thought it was legitimate, so I went out and started going out and finding people who were offering this or selling this, and it wasn't that easy to find. Like it wasn't. I mean, it took work to find groups that are actually offering life settlements, especially on the scale that maybe my family or I could invest in. And then I went out and interviewed 5 or 6 different groups, and then we invested with 2 of them in the late 2017. So we have a little bit of been here for a little while, and. One of the groups we invested with is Life Settlement Advisors, and Leo LaGrotte is the president and founder of this, and Leo's going to start us off. So.
Thank you.
First of all, thank you all for coming out tonight. I appreciate your time this evening. We'll try to make it as efficient as we can. The objective tonight is to provide as much education about this asset class. I'm going to walk through a presentation. A lot of questions are going to come up, so I would encourage you to ask questions throughout the presentation, or if you have a pen and paper and you want to jot something down, certainly do that. And when the presentation is over, we'll certainly be available, Gerard and I, afterwards for questions. So I want to start with a quick survey. How many people had heard about the life settlement industry prior to the announcement of this MIG meeting? so about half. Now, the folks that raised their hand, was it about just someone selling their policy, or was it someone investing? So if you raised your hand and it was about selling a policy that you no longer wanted, what's that group look like? Raise your hand. Okay, so some people know about investing as well. Okay, so great. So we've got a little bit of background. So I'm going to operate this, just roll the,
Yeah, roll the wheel, yeah.
okay, here we go. So what is a life settlement? By definition, a life settlement is the sale of an unwanted or unneeded life insurance policy into the secondary market. So think about your home, think about your car, think about any valuable asset that you have. If you no longer want it, there's a secondary market for that asset. Well, life insurance is no different. So we'll talk more later in the presentation about who qualifies to sell their policy, but when you stop and think about the life insurance contract, it's an asset. It's a piece of property that you can sell when you no longer need it. Why would someone want to sell their life insurance policy? I get that question a lot, especially from folks that are a little bit younger. So let's think about someone that may be in their 40s, 50s. They buy life insurance or they own life insurance because they want to protect their loved ones. Maybe it's college funding. Maybe it's to protect the other spouse, significant other, with replacement income. Or maybe it's to pay off a mortgage. If it's a business situation, you buy life insurance for a business to protect those assets. But fast forward your life, you're in your mid-70s. The kids have graduated from college. They've got good jobs. The home's paid for. If you're a business owner, maybe you've sold that business, so you no longer need that life insurance. So consequently, people let it go. Now, this is a statistic that I think is staggering, but in 2019, seniors 65 and older will surrender over 500,000 life insurance policies. Think about that for a minute. Question?
What does surrender mean?
Surrender, great question. So surrender means they decide that they don't need that policy anymore. So they go to the insurance company and say, I want to cancel it. And if they have any cash value in the policy, the insurance company will send it to them. Any questions so far?
Do you work with, I'm sorry. Do you work with attorneys?
Absolutely.
And that's in some.
Absolutely. So where do we find, maybe the bigger question is, where do we find life insurance policies of people that want to sell? So atypical would be a trusted advisor, an estate planning attorney, an elder law attorney, a CPA, a stockbroker, a financial advisor, or possibly even a life insurance agent. That's very common. So how long has the life settlement industry been around? Well, there was a Supreme Court case back in 1911. And that's really what made or set the groundwork for the life settlement industry. It was an interesting case. There was a gentleman named Brasher who needed surgery, and he didn't have the money to pay for it. So he goes to this doctor, Grisby, and says, hey, I need surgery, but I don't have the money. Well, they bartered. He gave them or signed over the ownership of the life insurance policy for the surgery. Well, Russell came along, was an heir to the estate after Grisby passed away, and said,
was the surgery successful?
It was. It was. Several years after the surgery, Grisby passes away. And so Russell comes along and says, well, wait a minute. I'm an heir to this estate. I want that life insurance. And of course, it went to the Supreme Court. And it was decided, the Supreme Court decided that this is property and it can be transferred. Okay. Question?
Yeah, back here. On the previous slide, it says that it's been a market for 20 years. Why did it take so long, and what spurred the market to start?
Great question. Okay, so if the life settlement industry, the foundation was laid in 1911, why not till just 20 years ago did it come about? And it's because of the products the life insurance companies have sold. The most common policy sold is a universal life contract. Why? Because it has flexible premiums. You don't have to pay that target premium every year. So if you've got some cash buildup in your policy, you can forego a premium this year and it will self-fund. Well, there's an arbitrage that can be created with that policy, because an insured, take a senior who no longer needs that policy or wants that policy, they decide they're going to let it go. Well, let's say they have a 5-year life expectancy, and let's just say, for example, it's $1 million contract. And let's say that they've got $100,000 in cash surrender. So if they go to the insurance company and they say, I want to surrender it, they get $100,000. But in a life settlement transaction, the value of that is going to be driven by their life expectancy, which is medically underwritten, and the ongoing premium costs. So that policy could be worth $250,000, $300,000. If they have a life expectancy within a couple years, it could be worth $500,000 in the secondary market.
So the products that the life insurance companies were selling changed 20, 25, 30 years ago, and that opened up the window for this.
Absolutely. That's exactly, because you've all heard of a whole life insurance policy. A whole life insurance policy fills up with cash, and there's a target premium that you have to pay every year, and if you don't pay it, there's a loan that's created. Well, with Universal, as I mentioned, you have flexible premiums. You can forego that. So that's what's created the industry. Excellent question. So let's talk about what makes life settlements attractive to investors. Well, first of all, when you think about equities, real estate, and fixed income, all three of those asset classes are correlated. Now, correlated, for those of you who know what it is, it goes with the economy or the political environment or interest rates. So when you think about correlated, think back to 2009 when the Dow in March hit 6,000. Well, obviously equities are correlated, whereas life settlements, it's a death benefit. It doesn't change, and so it's unaffected by any economic environment, political environment, or even interest rates. So that's why investors are so interested in this asset class, because we know that we will have another recession. We just don't know when, and we don't know how deep it'll cut. So from a life settlement investment, if you invest in this asset class, and let's say you own, I'll use round numbers, $1 million in death benefit, that $1 million will always be there. Now, what your rate of return on that investment will be, that will vary, because if the policy matures early, obviously your internal rate of return will go up. If the insured lives beyond life expectancy, your internal rate of return will be diminished and will go down. The life settlement industry, been around 20 years. It's regulated in 45 states. This is an industry that is very heavily regulated for obvious reasons. We're talking about individuals that have a very valuable asset, and each state will regulate that. So, for example, in the state of Michigan, if business is done in the state of Michigan and there's an issue, the Department of Insurance in the state of Michigan would be involved in that particular case. Another aspect of the life settlement market that I think investors are very attracted to is that it's underwritten by A-rated life insurance companies. So when you think about the asset itself as an investor, it's a life insurance policy. It's a life insurance policy that, let's take, for example, Transamerica. They're an A-rated life insurance company. You don't hear of life insurance companies not paying a death claim. So when you think about that particular asset underwritten by an A-rated life insurance company, what's the risk of you not receiving your principal as long as you have paid your annual premiums? It's very small. So from a risk perspective, if life insurance companies weren't paying death claims, you would hear about it. It'd be all over social media.
And part of maybe the risk that these quality life insurance companies, the risk is low that they're not gonna pay the death benefit is because this has already been litigated many times, and the states, you know, I mean, enforce it. I mean, like, you know, the insurance companies don't want, insurance companies don't want people to sell their policies like this. They want them to stop paying premiums and just, just surrender it. So they used to fight this a lot. The insurance companies would fight this. They said, no, we're not gonna pay this investor. But that's been handled in court, and it's been.
Absolutely. Another interesting statistic. Life insurance companies only pay out claims on 15% of the policies that they sell. So stop and think about that for a moment. That's why whatever city you drive into, the biggest building is typically a life insurance company.
You know, I'm just interjecting here, but to me, I say, what if you had a business where you only had to deliver product to 1 out of 8 customers? That's what it is.
Absolutely. Question?
But yet all 8 of them paid for it.
Yeah.
But why did the other 85% not pay out? Say that again?
Okay, so John just brought up a great question. So in the life insurance industry as a whole, they pay out 15% of the claims. And John's question is, well, why did the other 85%, what happened to them? What happened to that policy? Well, they surrendered it, or they let it lapse, meaning that they couldn't afford to pay it, and it went away.
Stop paying premiums.
Now, can it also go on the product, like maybe you have to go by term, so it doesn't matter anyways, or?
Well, term, surprisingly enough, 95% of all term policies are never presented for a claim, because term is for a period of time,
Buys a window until you make it through that window,
and then it goes away automatically. Now, all term policies have a conversion rider,
which is expensive, you're not gonna do it.
unless you absolutely have to have it.
Somebody said that 85% could be a little skewed, because it has to be term, and, I mean, I'm not trying.
No, you're exactly right. It's all life insurance policies. It could be term, whole life, permanent.
And the products that people like you buy, is it always whole life?
Actually, the vast majority of policies that are purchased in the secondary market are universal life policies and term policies that are convertible to a universal life product. And the reason a whole life policy is not purchased, it's not common, is because it fills up with cash.
Yeah.
And from an investor's perspective, the hurdle to get over that cash surrender value is just too high most often. Question?
He actually answered. I was wondering if the data encompassed the term policies, because that would technically skew the percentages.
Sure, absolutely. Any other questions? So let's move on. So what are the disadvantages, or what are the risks associated with investing in this class? And I'm going to talk about 3 of the major ones. First of all, when you think about this asset class, longevity is the greatest risk. Will the insured live beyond life expectancy? Now, I'm sure all of you are probably thinking, well, how is life expectancy determined on an insured? Well, there is a significant process that we go through. And step 1 is the medical records of the insured. We're going to gather the last 3 years of the medical records. No differently than when they purchased that policy, that medical file is going to go out to an independent third-party underwriter that specializes in the life settlement industry. And they're going to determine the longevity of that insured. Now, that's the greatest risk, in my opinion, because some policies can mature early, other policies can go long. You can't measure the will of someone to live. But from an actuarial standpoint, the life insurance industry has gotten really good at this. And the life settlement industry has piggybacked on that. And they certainly use that data. And I can tell you, I've been in this industry for 20 years, and the actuaries today are much better than they were when they started. They have more data that they can utilize. So that's your greatest risk. Liquidity is probably your next risk, meaning that you're not going to get your money until the policy matures. So you have to be an accredited investor to participate in this type of an asset class, because the last thing we want is an investor to get into a situation where they can't afford to make the premium payments, because depending upon the investment, there can be premium payments with it. And the third is credit risk. And we talked a little bit about this earlier, but credit risk, meaning is an A-rated life insurance company not going to pay a death claim? Has anybody heard of or know what a 2-year contestability clause is with a life insurance policy? Does anybody know? Okay, so I'll explain, since most of the folks didn't raise their hand. So when an insured buys a life insurance policy, inside that contract, there is a 2-year contestability clause. And what that means is the insurance company has 2 years. If they feel that there was something amiss with the application process or something that was stated in the application, they have 2 years where they can rescind that policy and return premiums back to the insured. So in the life settlement space, no policy is going to be purchased until that 2-year contestability period has been met. So you don't have to worry about a policy being contested.
That's from the beginning when the policy is purchased, or at the end when the person has died?
From the time the policy is actually purchased, there's a 2-year contestability period. So if a policy was purchased in January of 1st of 2017, that policy wouldn't be even eligible to be sold in the life settlement market until.
It wouldn't have any cash value anyhow.
Well, the cash value is a factor, but from the point of a sale, the cash buildup is not something that.
What about on the other end? Okay, how long does it take you to get your money when the person has passed? And how do you know that the person has passed? You know, you're sitting there in your office. And do they somehow slow walk that, or what happens then?
Okay, 2 great questions. So how do you know when someone passes away? So with our firm, we have a turnkey product. So we track the insured. And there's a contract when you sell a life insurance contract is much like a first mortgage. There are many disclosures, but one of the aspects of the contract, the seller has to designate 4 contacts. And those contacts are going to be followed up with throughout the course of the year. Has the insured had a change in health? Has the insured moved? And through that contact, we know where the insured is. Now, we also have irrevocable power of attorney over the medical records. That's part of the contract. So a couple times a year, we're getting updated medical records on the insured. So we know the status of the health of that insured throughout the course of the year. Once they pass away, then we have to receive the death certificate, which typically can take a couple weeks. There is documentation from the insurance company that has to be completed. Once that documentation and that death certificate has been received, it's submitted to the insurance company, and in typically less than 2 weeks you have your check. The insurance company cannot slow walk this. It's been my experience with death claims over the years that those are paid out very expeditiously. And Gerard will speak to that because Gerard recently just had a policy mature last month. So he can talk about that.
Leo, what happens if the person commits suicide?
Okay, great question. What happens if an insured commits suicide? Well, that's where that contestability, that 2-year contestability that we were talking about earlier. So let's say that a policy was sold into the secondary market. It's met its 2-year contestability. A year later, the insured commits suicide. The death claim is going to be paid. Why? Because the 2-year contestability has been met.
No longer has the opportunity.
I mean, it seems like you'd wanna buy those ones that are less than 2 years, cause that's better for you, cause that means someone hit a heart condition, so I can see why the insurance doesn't, it's that 2-year window, cause they wanna see if so-and-so lied about these health conditions. So if anything, you'd rather buy those ones that are less than 2 years.
That's already passed, so once it goes into the secondary market, that 2 years is passed.
I know, but I'm saying if we didn't have that, it seems like the insurance company made that rule to protect themselves, cause we'd wanna buy those ones that people. Sorry.
Oh, that's fine.
Well,
Any-
you could, but it'd be higher risk. You'd be higher risk investment. Because, insurance company could cancel and say, no, I'm not paying them.
Right.
Are these typically one-on-one transactions where you're buying, John or Jane Doe's policy? Or are they, it seems a little bit morbid to me, I guess. It would seem a little bit more palatable to have a fund, to where you buy into a fund that does that. Is that something, is that a
Well,
product that you want?
let me, that's a nice segue into our next topic. So how do you participate in a life settlement transaction as an investor? Well, there are typically 3 ways. The first way that you would participate would be in a fraction. A fraction would be a piece of a policy where it would be chopped up and you would have many different investors. Why? Because that typically is a smaller investment. Minimums on those can typically be $25,000 and then you can go up. In a fractional investment, typically you'll write a check. Let's say it's a $25,000 minimum. Let's say that the life expectancy was 5 years. So that $25,000 would include all the premiums to life expectancy plus 1, possibly 2 years. It would include any maintenance or tracking fees associated with processing that claim. So that is one way. And you can invest in multiple policies with a fraction. Another way would be whole policies, where you could buy a portfolio of policies, you could buy a small pool of policies, or you could buy just one policy. And then a third option would be to invest in a fund, where there are many policies involved. Now, when you talk about buying an individual policy, and I'll digress for a moment, an individual policy, our minimum that we sell is $100,000 in death benefit. So a $100,000 life insurance policy could go for maybe as little as $15,000, $10,000. But then you've got the ongoing premiums that have to be paid with that. Whereas a large pool that may have hundreds of policies, and it's going to depend upon the pool, they may have a minimum of $250,000 before you can even invest in that. So it's really going to be dependent upon the individual investor and what they're looking for. Now, the ooh factor, I think, is maybe what was somebody said that earlier, and I hear that a lot, that ooh factor, because you think, well, I'm going to profit on somebody's death. Well, and you are correct in that, and that's what life insurance is all about. But what I say to people is think about the good and the benefits that you're providing the individual that's selling that policy. So think about, most people are selling their policy because they don't want it, they don't need it, or it's too expensive. So for the family that mom and dad are retired, they need some money to supplement their income. As I mentioned earlier, most often the kids they're grown, the home's paid for, the kids have good jobs. They don't need this coverage. That's why 500,000 policies will be surrendered this year. So when they sell that, call it a $500,000 policy for, let's say, $100,000, where if they went to the insurance company and surrendered it, as we talked about that earlier, and they only, let's say, got $25,000, you're doing a tremendous benefit to that individual because they're getting 100 now by selling it versus 25 by surrendering it.
What are you saying is the cash value of that example that you just gave?
In that example, 25,000 where they could surrender it back to the insurance company versus 100 by selling it into the secondary market to either an institutional or accredited investor.
Then what would be the death benefit on, using an example like that? Using those numbers, that $100,000, that person, if that person died the week following, what would that,
The investor would have got a $500,000 check
$500,000?
because that was the death benefit in that example.
Whether it's a week later or 10 years later.
I think I've taken up all of my time.
So your firm, you act as the agent in the middle. Your clients don't interact with the insured people, and you go out and work with, you go out and source.
Great question. So,
Settlements, and then you have them under control, and then you may have a death benefit that's $1 million, and you bought it for $200,000. You already have it, or your firm has it.
Right.
And then you'll sell $50,000 pieces of that. You'll sell to 4 different investors.
so great question. So how do my firm, how do we interact in this process? So we work with the trusted advisor. So when I say trusted advisor, I'm talking about CPAs, the attorneys, the life insurance agents. And then we work with institutional and accredited investors. So we go out and source the policies, and then we bring them to the investor so they can invest. Now, in our process, once you invest, we manage all the due diligence. We'll tell the investor what the premiums are that have to be paid if you buy a whole policy, and we'll tell you when to pay those. From an investor's perspective, that's the only thing they have to do. Now, if they participated in a fractional sale, the only thing they have to do is write a check. They don't have to make any premium payments, or they don't have to worry about when those premium payments are going to be made. Does that answer your question?
Yeah, so, you're not interacting with the actual insured party.
Right. As an investor, you have no contact with the seller of the policy at any point in time, at the beginning of the sale, in the sale, or at the payment of the claim. There is no contact. We're the intermediary between the investor.
Buying a whole policy, we are, in fact, sending in a premium once a month.
Correct.
Okay.
Question.
So in like a private equity group or collateralized something, a group of these things, bundled group, how do the premium payments work then? Because you probably got a bunch of different premium payments and.
In a large pool of policies, you make an investment. It's similar to a fractional share. The fund manager, excuse me, the fund manager will make all those premium payments and incur all those expenses out of that check that you wrote.
It's just an expense to the fund.
Right, correct.
When you raise the money for the fund, you're raising a reserve to pay the premiums, what you expect the premiums to be over time.
Correct.
Can you just give me an idea of what when you do those funds, what are generally the size, the minimum investment? And you said double-digit returns. Is that 40%? Is that 15%? What's your?
So I can just speak to my knowledge and experience. When you look at a fund, and this is an important question because there is a distinction. So when you think about a fractional sale, in the example earlier, a $25,000 investment, that investment includes all the premiums and all the expenses. So if you go into that particular policy, if that policy matures early, you're going to be able to capture some upside with that, at least with our firm. Not all firms are that way. In a whole policy, the concept is similar, and Gerard's going to talk about this as well. But when you buy a whole policy, we'll give you a schedule of the premiums, how much the premiums are, and when you need to pay them. So let's say that the life expectancy is 5 years. And if you make your premiums and in year 3 the policy matures, well, your internal rate of return is going to go up significantly. If the insured lived beyond the 5-year life expectancy, it's going to be diminished. So you're going to capture the upside. Now, in a pool, typically you're going to have some set return, and that return might be 10, 11%. If policies mature early, at least my experience is, you don't capture that upside.
Well, the law of large numbers becomes more relevant with over 100, 200, or 400 policies versus you're just rolling the dice with 1 or 2, right?
Absolutely.
So, are you saying that if there are a significant number of early maturities, oftentimes that's to the benefit of the fund manager and doesn't pass on to?
Well, it depends on who the fund manager is. But I can tell you from my experience, what I've seen out in the marketplace is that the fund manager will set a return. And it's a fixed return. And if policies mature early, most often as an investor, you're not going to participate in that. So let me give you an idea of, there's really 3 different buckets of investors out there. So the first bucket of investors are folks that say, you know, this asset class is really intriguing. I'm interested in it. I really want to learn how it works. And they'll do $25,000 or $50,000 in a fractional sale. And then they'll see how that process works and get a better understanding. The second bucket of investors are investors who say, you know, I understand the asset class. I get it. I want to start building my own portfolio of policies, and they'll ladder those policies. Laddering meaning the longevity risk and the size of the policy. They want to capture the upside. Is there risk there? Certainly, but they understand that risk, and they like the opportunity that they can potentially have a policy mature early and have triple-digit returns. And then there's that investor that says, you know, I really don't want to spend a lot of time on this asset class. I just want to write a check. I want somebody else to worry about it, somebody else to manage it. And that's where I think a pool of policies comes into play. And that's from my experience, 19 years being in this industry.
When you do one of those pools, just give me an idea, if you stacked up, you know, the office, you know, your fees, the accountants, the lawyers, what is that as a percentage of the revenues that are coming in? I mean, is it what's the?
Well, to answer your
what's
question,
payday?
on a large pool, we're not doing a large pool right now. And the reason for it is because of the amount of capital that you have to raise and the amount of policies that you have to go out and purchase.
But I'm paying you for that, I write the check and say, go, do your thing, you know, and how much are you charging? I mean, roughly.
So what kind of fee can we make when we sell a policy?
Right.
It's similar to a real estate deal. We can make up to 7%. Sometimes we'll make more, sometimes we'll make less. A lot of it will have to do with the ability to acquire that policy. We might be in competition with other buyers, and the price might get driven up.
And that's fully encompassing the legal, the accounting, and stuff like that, just
Correct.
like a real estate deal.
Correct.
Okay, I get it.
But in essence, you don't really care. I mean, if it's an 11% return that you're being guaranteed.
Well, not guaranteed. It's still life expectancy.
To your point, sir, that's how I address it, because what Leo makes on his buy and sell, I'm about what my return is, right? I don't care about the other side.
And I guess to sum it up and see if I'm wrong here, but you're talking about, as you said, it's an uncorrelated asset class, 11% return on a AAA rated or an A rated insurance company, but the only real risk of your longevity of, you're not sure when you're gonna get all that money back necessarily, right? I mean,
You're absolutely right. You're absolutely right.
where do you get 11% in a AAA rated?
It goes back to what we were talking about earlier. The underlying asset is about as strong as it'll get. It's an A-rated life insurance company.
Is there a point where you'd actually lose money if the person lived long enough?
Absolutely. And as an investor, you would know that. Because one of the things that we do is we show you, here's your return to life expectancy, and here's when you break even. So you're going to know that. Some policies, as a whole policy, you might have what I refer to as a tail. Your break even might be 5, 6, 7 years past life expectancy.
So when you buy this, what do you get for collateral?
You get the policy.
The actual policy itself, and then you're paying it directly to the insurance company?
That is correct. If you're buying a whole policy. Now, if you're buying a fraction or if you're in a fund, it's going to be handled differently, because typically in a fund or a fraction, an entity owns it, and they're going to make sure that those premiums are paid.
A trustee would own it then? and-
Correct. Cool. I think we had a question here.
Would it be true that in the case of, what's a scenario where you would lose money most likely? Would it happen more likely if you're buying individual policies because there's a higher upside and a higher downside, where in a fund, the actuarial numbers kick into play, right? Because it's spread across a large number.
You'll have some long ones inside the fund, you just won't know.
Right, but it should even out.
Yeah.
Whereas in one single policy, you might lose the whole thing or make a killing.
Right. You're right. And what I would tell an investor that came to me and said, I want to buy one policy and that's all I'm interested in, I would say that's probably not best suited for you. You would be better off to take whatever that amount of money was. If it was a small amount of money, then a fraction. If it's a large, if you're talking about $250,000 or more, I would say go into a pool.
So
I think we have.
if you're losing your shirt on it, couldn't you just surrender it too?
Well, you wouldn't surrender it. It's an asset. You'd sell it
Okay.
and recoup whatever you could. John?
So we talked just briefly before about a ladder where you buy policies that have actuarial data that said one this year, one this year, one this year, one that year, to try and make this fund paying out consistently. Talk to me about that. I mean, are those 25 policies? Are they 10 policies? You know, what does that look like?
Well, I think a lot of the questions that Gerard would be able to explain these well, because he's done all this himself as an investor. So maybe, because are we doing okay on time?
Yeah, you can, Gerard can go there, sure.
Okay, so what I'd like to do is wrap up my part of the presentation. I'd like to introduce Gerard, and I think some of the questions are going to be applicable to him. So I've known Gerard Benner for 10 years. Gerard was introduced to me through his financial advisor. His financial advisor was hoping to market this product to all of his clients, and his broker-dealer said, no, we're not going to allow you to do that. So I approached Gerard after follow-up and some educational material. I got his attention, and Gerard started investing. Now, Gerard now is a colleague of mine and works with me. So started out as an investor, and now he's a colleague in the company. So Gerard Benner.
Right, so Leo shared a little bit about who I am. I will just a quick blurb on whose I am. I'm a flawed man of God with a passion for life settlements. And you think, wow, that probably doesn't go together. But it does. And I'm here to offer you a perspective from an investor and a CPA on how this asset class became a part of my knowledge base and, frankly, a very significant portion of my family's wealth portfolio, because I think so much about it, think so much of it, and about it, frankly. But I was a little reluctant, or I should say a little, I was highly reluctant to give this the time of day, because I'm guessing you, like I, get these great opportunities all the time, right? And I looked at it as another investment scheme that sounded nice and probably didn't warrant my consideration. So I put it off, and as Leo mentioned, my financial advisor was the one that brought it to me, and I continued to put it off. And then I went into the, as he mentioned earlier, the ooh factor, thinking that, you know, I felt like, gosh, I'm profiting from someone's passing. As a male, my wife thought, we're not doing this. I'm not going to make money on someone dying. So it was a difficult hurdle for us both to get over until you think about it as a transaction, right? The seller, for whatever reason, has already made a decision. I'm going to surrender this policy in some way. I don't need it. Okay? So they're going to get rid of it in one way or another. That decision's already been made. There's no convincing. The advisor's already come to Leo and said, hey, I got a policy for sale because my client wants to get rid of it. So you're not really convincing him that you want to pass, or he or she, you want to benefit from their passing. They already made that decision. This policy's gone. Okay? So they have a policy with a certain cash value in it. So that's their bird in the hand. They can take it back to the life insurance company and they cut them a check for their 10 grand of cash value tomorrow. No big deal. Everybody can do that. What this asset class offers is two in the bush, right? They get some multiple of that cash value, and different policies are different amounts, but I believe the average is 8 times the cash value from the seller's perspective. All right, and from the buyer's perspective, the investor, if you will, they're getting the eventual matured proceeds. So there's no loser in the whole transaction except for life insurance company. Exactly right. And I say loser, they sold the policy with the ability for it to mature. So that's not news to them. They know they can mature, but they're assuming that's going to be one of those 85% that gets surrendered without having come to maturity. And that's why they kind of frown on the asset class, because, oh my gosh, I have to deliver the product, as David mentioned. So I finally gave it my consideration, as I mentioned to someone earlier tonight. It was Leo and I. It was love at third sight. It took me a while, right? But as I started listening, and his approach to people as a listening and learning and an educational method, I thought, there may be something here worthwhile. And so I continued to tap my toe in the water and lean on Leo for information to learn. And I purchased my first policy as a fractional interest. All right, I tapped my toe with a fractional interest in the space so I could learn more about it, see how the whole process worked. I wasn't ready to commit to one policy because, as Leo mentioned, you're kind of putting all your eggs in one basket and thinking that one might mature. I continued learning, and eventually my first purchase of a full policy, I actually purchased 6. And to Chip's point, I did it in a laddering mode. So I had some that was as early as 2 years of maturity, some as much as 8, and tried to fill in that gap of having a planned, a actuarial, if you will, liquidation event ongoing to help the cash flow and the liquidity risk, if you will. So that seemed to make good sense to me, and then along the way, I've added additional policies within wherever I feel my gaps are, timing-wise, and frankly, where I thought the opportunity was best with regard to the policy. And I now own 12 policies, full policies, and 3 fractional interests. So I've got them in various maturing ranges for that very purpose. I've had the experience of matured policies. I've had 3 mature over that. My first purchase was like 7 years ago or so. I've had 3 of them mature. My return on those 3 of the actual maturing are over 20%. That wasn't my hurdle rate. Okay, my hurdle rate was in that 11% range, 12% range. That's my expected return. All right, and that's how I look at these policies when I evaluate them to begin with. I got a hurdle rate of X. Your X may be more or less than 12. I got a client whose hurdle rate is 8. He's that's acceptable to him. It matters what your goals are. But the point is, as you look at these policies, the death benefit amount, the matured amount. You know the premiums along the way. You're given that information. You know their projected date of maturing and along with the amount. The only piece you have to figure out is what you can put as a downstroke to begin to purchase the policy to begin with. At that point, it's math, all right? Because then if your hurdle rate's 12 or 10 or 8, whatever it is, you can afford to pay so much for that policy. And because when you purchase a policy, it's kind of like buying a piece of real estate or an asset. You're going to put in an offer at a certain level. And that itself is going to come back and say, well, I can't take 100 for it, I'll take 150 for it. And you say, well, I can't give you 150 for it, I'll give you 120. Question?
So just to correlate those percentages, what's the tax treatment of a death benefit?
Yeah, let's say.
That's a good,
Is it a long-term gain, or?
it's an excellent question. And as most accountants would answer all those kind of questions, it depends, right? Yeah. So it does depend, because a normal policy in the purchasing it for X and selling it for Y, it's ordinary income. Okay? A few years ago, and it's now under review, the final regs haven't been released yet, but a few years ago, there was an opportunity to purchase these in a LLC structure, allowing the insured, the new original beneficiary, to retain a portion of the policy. And our recommendation was 5% or more, but at least 5%. If you did it that way, so you in effect buy 95% of it, your proceeds were tax-free. Not capital gain, tax-free. The death benefit, yeah. And why? Because life insurance in its nature is tax-free, right? If your spouse gets your death benefit, she didn't pay tax on it. So that's just life insurance 101, if you will. And by using that structure of the LLC and allowing the insured to keep a portion of it, that makes everyone under that tax-free umbrella. Now, I say that, there are regs that say, wait a minute, this is too good to be true, right? So, as we speak, they haven't been given final regs yet to say that it's going to go away, but it sort of appears that way. So the window is fairly narrow and could be a little aggressive by taking that position as we speak. Most tax laws are from here forward, right? Some can be retroactive. So if you bought it with that idea and they made it retroactive, you're back into the taxable gain.
So the insurance companies worked really hard to close that window.
I don't doubt that. Yeah, I don't doubt that. Yeah.
So getting a death benefit on someone else's insured life, that's not tax-free to the person, like your policy. Those are not tax-free.
So I bought some under the LLC version as well, and those are tax-free. I gotta believe they're not gonna make it retroactive years. If anything, it's gonna be weeks or months, not years. So I do have some of that.
That's gonna go away.
If I was a betting man, I'd say yes. But,
Hey, you know what I mean?
sure.
I know taxes are really important, but, my point of entry here was the non-correlation.
I agree.
Not
Yeah.
necessarily the tax treatment or the returns even, it's the non-correlation. What else can you invest in that isn't gonna be affected by inflation, GDP, interest rates, wars, politics? It's not correlated.
But the big pitch that the insurance companies make is that money is tax-free. I mean, and that's their big hammer.
So you can get that, so you
That's
can
their
get
big
your
hammer.
3%
And so
return
I am
tax-free.
sure they're gonna fight to close that
Oh,
LLC
joy.
door as quick as they can
Yeah.
slam it shut.
Yeah. So,
That's kind of
I
funny.
mentioned in the process of buying it, it is a bidding type event if you're buying the whole policy. But again, if you have your hurdle rate and you then therefore fall out that original purchase price, you stay disciplined, right? Because if your purchase price is $150 to get your hurdle rate and you want to buy it for $175, you're accepting a predicted lower rate.
And
Dave?
you're more of an active investor in the space. I mean, there's a lot of avenues to invest in the space where you can be totally passive. If you buy into the concept and you want to invest, you don't have to, you're not going to negotiate with anybody. You're going to pick an advisor, pick a fund manager, and go with them. but, Gerard's a much more hands-on investor and sharing his, hands-on experience, but
And I'll tell you this, I mean, you're right, you could do that route. I told you 20% what I've realized. The 12 policies, or 15 with the fractionals, that are in play, if they mature at their maturity date, not early, not late, I'm gonna get 14. Okay? The funds won't get you that, but you gotta work at it. You gotta be more active to it.
So with regards to taxes, with the individuals, so we're saying, if we're just gonna disregard the 5%, just assume that that's gonna disappear, we're talking, ordinary income tax.
Correct.
If you were to purchase those individual funds with a self-directed Roth, how would that,
I have several in my self-directed IRAs. That's an excellent option. The retirement accounts are super for that purpose, Roth or even regular, being a deferred of taxes. It's a good reason to use it. But frankly, the liquidity aspect of your retirement fund, you're not looking to get that money anyway, unless you're 59 and a half or more. So the fact that you can't get the money to go buy a house with doesn't matter. It's in your IRA. So that using your retirement funds for that purpose is a great match. I was gonna get to that, but you beat me to it. That's good.
so with the Roth, there wouldn't be any, what is that, unrelated business income?
Alternative minimum tax?
What's that?
Alternative minimum tax or net investment tax, which,
No, the UBITs. There wouldn't be any
oh, no.
So there's just no tax at all?
None. This investment side of a Roth is the same as a CD or a money market or some simple thing. Yeah.
So these policies you bought, let's say from Leo, I don't know if all 12 came.
They were.
Does he give you like a whole bunch of opportunities? You put in a matrix, you kind of have an algorithm, you kind of look at the data like, okay, I got a 50-year-old in
You do.
Southeast Hampton.
You get a spreadsheet that has what we call a policy data sheet,
Okay.
which gives the life insurance company the actuarially determined maturity time frame, the optimized premium, so you know what those numbers are,
Yeah.
the medical conditions
Sure.
of the insured. He's got this issue, this issue, this issue. And that's all important information, but as my perspective as an investor, if the actuary says his life expectancy is 7 years, 6 months, what do I know about medical conditions?
No, but sometimes
Right?
demographics, if they're in an urban city, maybe more dangerous, and then you can get some good.
I agree, and you get that information, and if you want to trust your judgment better than the actuaries, you can do that.
When we had
I have
the
investors
housing
who do
guy,
that.
He went to Tennessee and he went to Texas because that was really where the low end jobs.
Yeah.
So housing was those. So I was thinking like Washington, which has the biggest suicide rate. Maybe that's a good one. That
Yep.
70-year-old in
Yep.
Washington might be a good.
Well, let me interject. Let me interject for a minute. So we haven't talked much about this. What are the characteristics of someone that's selling their policy? Well, typically, you're talking about someone that's in their mid-70s or older. They're retired. They obviously don't need the life insurance. Now, when you get into younger folks, typically you're talking about someone who may have a terminal illness. So most often you're talking about older individuals that are selling their policy. Now, let's say that you have someone that's 60, maybe they have a terminal illness, their doctor says you've got 3 years, maybe they've got cancer. Why would they sell their policy? The ones that do is because they want the money now to enjoy. They don't necessarily want to leave it to someone else, so.
You got a bucket list they want to.
They've got a bucket list or whatever they choose to use the money for, but keep in mind, we're talking about seniors when it comes to the policies that are being sold.
So is it fair to say that this is a similar product to like investing in a reverse mortgage type situation? It'd be similar type person would be, somebody that'd be inclined to do a reverse mortgage would be somebody that'd be inclined to sell their.
Demographically, that's right. Yeah, the process is, but demographically.
Bill, here's following up on that. What is the process for that person? Do they go to their financial advisor, or do they come to you directly? How do they initiate the sale?
So that's a great question. So the folks that have some net worth and work with a financial advisor, typically they're gonna go to them. And their financial advisor would come to us. And the process is very simple. We have a questionnaire. We need to get a copy of their policy, the most recent annual statement, company information, life insurance company information. And then we start that due diligence process. We get their medical records. Once we have those, they go out to an independent third party who will determine life expectancy. And then we can determine the value based upon the ongoing premium cost and life expectancy. For individuals that don't have the resources to work with a financial advisor, maybe they have 100, 150, or whatever the number is in death benefit, they're going to the internet. And they're doing a search, just like any other product that they're looking for.
And have they committed at that point, or they, when it's turned over, can they pull back and go, oh, if it's only gonna get me 50 grand, then never mind?
Great question. What's the commitment point? So let's say an offer is made, an offer is accepted by the seller, then contracts are sent out. Once those contracts are executed, then the change of ownership and beneficiary designations are submitted to the insurance company, and this is a critical point. Once they're executed at the insurance company level, meaning that ownership and beneficiary has been changed, then they receive their money, but they still have a 15-day rescission period after that. So they can rescind at any point up to 15 days after they receive their money. After that, they can't do anything about rescinding.
And when that advisor's coming to you, can he say, listen, my client would like to get between 100 and 150,000. If that's gonna be doable, then yes, but if not, then no? Is that how that maybe goes?
Well, very, very similar.
Okay.
There's a qualification process. And part of that qualification process is understanding how old the insured is, what type of policy they own, what's their medical conditions, and what's their expectation. Because occasionally we get people that'll come to us and say, well, we've got $1 million policy and we want $850,000 for it, and they got a 10-year life expectancy. Well, your expectation is unrealistic. Good question.
So from my perspective, I just want to summarize why I like this asset class. And David hit on the first one, absolutely, the fact that it's non-correlated. The stock market is fine in some instances, and I have some of my assets there as well. But I don't like the fact that somebody in Greece hiccups and our market goes down 20%, right? This, once you understand the asset class, is pretty vanilla, actually. You know, it's money in, you're committed to your premium levels, and when the maturity event happens, they send you a check. And someone asked how long that process is and do they drag their feet. 30, 45 days max, I've had my checks. In fact, I forget the number of days, but they have to pay it out in so many days, or they have to pay interest. 30 days, okay. Yeah, they have to pay interest. I like the upside potential. If you think about, in one sense of the word, of the concepts here, if you buy a short-term policy, you think that's probably a better choice because it's going to mature quicker, right? True. From a liquidity perspective, that's true. But if you buy a longer-term policy, again, you buy it assuming the actuary knows what they're doing, right? They're very accurate. That's how they sell life insurance policies to begin with at the life insurance level, is by hiring these actuaries. So they're no dummies. You make that assumption when you buy it that they're correct. However, if an 80-year-old has a 10-year LE, life expectancy, what do you think the chances are that they'll live past 90 versus before 90, logically? Well, actuarially, you're absolutely right. But logically, I would argue different. That's why I like the upside potential.
But how accurate are those actuarial tables? If 85% of the people are giving them up, they don't have to be very damn accurate to make a
It's
lot of
not the
money.
tables themselves, but they'll go into the specifics of that insured, right? I mean, actuarially, my life expectancy may be 35 years. But if I got a heart condition and I just went through a bypass and I got a family history that everybody's died at the age of 60, I bet my life expectancy is not 30 years.
So is that what you do?
No, we use an independent third party to do these actuarial studies. So, for example, Gerard mentioned earlier about the insurance company, and they've compiled all this data out there. And the same underwriters that are doing these life expectancy calculations came from the insurance industry. And now they're just doing the life settlement longevity studies.
If we were to buy a policy, say it was, just for example, it was a $50,000 we were buying a policy for 50 grand. We're gonna pay a 6%-ish, commission on that. Is that how that works? We'd be paying a commission to you to buy that policy. Is the actuarial and all the other things like that included in that?
Okay, so-
6%, or how would we buy it? If we were to buy something for X amount, what?
You have your investment amount that you know you're gonna pay, what you committed to buying the policy for, in your example, 50,000. You have the premiums you're gonna pay into it.
Right.
Leo has an annual fee to manage the policy, okay? So you know all the out-of-pocket monies predicted up front, and you know what that translates to in your investment return. That's it. You can calculate your rate of return. That 11-12% number I'm talking about, from my perspective, includes all that. Like I said earlier, I don't know whether on that 50,000 that I'm buying that policy for, whether Leo makes $5 or $5,000. I know I'm going to pay 50 for it. It's not 50 plus some percentage. It's whatever I decide to pay for it.
And that's pre-tax, unless you do this LLC gambit or a Roth IRA.
Correct.
So that purchase price includes the fees.
Correct.
Got it.
Correct. The other thing I like about the asset class is its predictability in terms of what your upfront knowledge is to your financial commitment. You know all those different factors we've gone over. That's attractive to me. And the assurance and therefore safety of the investment principal. They're going to pass away eventually. Yes, you can lose money. You may have more into the policy than the death benefit if the person lives long enough to where your premiums go forward. But you know, if you buy a $500,000 policy, you're going to get $500,000 someday. Even if you have 7 in it, you're going to get 5, right? So yes, you can lose money, but you can't lose the 5. Even Methuselah passed away, right? And lastly, and I know this sounds like a sales pitch for Leo, but I got to tell you, working with he and his wife specifically, you will never get better customer service and knowledge in an asset class than you'll get with him. I opened my talk about being a flawed man. He is a man of God, but I haven't found any flaws yet. As much as I look for them, I keep thinking, surely you're going to do something wrong, so I can say, aha, there you go. But he either hides it well, or he's a very nice man and very knowledgeable in the space. And I seriously, if you have an interest in the asset class, he's your guy. So I'm open to other questions if anybody has them. Yep. All right, I think David wanted to share as well.
You know, I'd focus more on the passive side of this investment arena. My family, we've invested in a fund that was with, might have 1,000 policies in it, and we've bought, a small portion of them. I personally have bought a fractional share with Leo, so I own 1/8 of a policy. And then, obviously, like you mentioned, you can buy an entire one. But I think the thing is you can do this pretty passively. Like, you don't have to be hands-on like Gerard is, as explaining. But you can if you want. But I haven't explored this at all, being the active investor. This is kind of from my impression of studying the space, when I looked at the most passive, most lowest risk way of investing in a fund, my studies came up and told me I'm going to expect that % return. And then, of course, the more risk you take, the more involvement you get, your returns expectations go up. So this was my study. This is what I came up with as my expectations from the different ways to invest in the space.
Once again, it says invest in settlement fund, buy fractional share of life settlement.
So Life Settlement Fund, we invested with a group called River Rock. River Rock is raising $200 million. They're going to buy 1,200 policies. And we have a small proportion of that fund.
Like a mutual fund.
Oh, and the second one is you're buying 1/8 of one policy.
Yes.
Got it, okay, I got it.
Yep,
I got it.
yep. So this is 1/8 this is 1/2, 1/8. 1/4 of a single policy. This is, you buy a complete policy, like Gerard was talking about. And, I'm sorry, this is if you buy one with help of Leo. This one is if you go out and find somebody with life insurance policy and you buy it from off the street.
I don't say
I'm just gonna skip through this. Basically, like our mobile home park night, I actually, you think I'm crazy, but I actually did a lot of work and investigated this a lot before we invested. And I have a report that if you want to check it out, send me an email and I'll send it to you. But that was what convinced me and my family to do it, was all that analysis. So I guess that's all. I think. Any more questions about life settlements? You guys, or just want to just?
A copy of the brochure of the presentation and our business cards are on the back desk where you pick up your name tags if you want to take them with you.
So, all right, well, thank you, everybody.